Welcome to Lloyd's List on the Radar on Friday the 24th of October, bringing you a roundup of the top stories in the shipping industry this week. It's been a week of mixed news for the markets, with the impact of the credit crunch and economic crisis continuing to seep into the day-to-day business of shipping. In the container trades, lines are cutting capacity and warning of worse to come. In the bulk markets, the Baltic Dry Index fell on the back of the freezing of trade credit, while major tanker markets showed little direction. Maersk Line is removing 9 container ships from Asia-Europe trades as market prospects continue to deteriorate. The Danish line has confirmed that its AE8 service will be temporarily suspended from mid-November, but has made no decision about when it may be reinstated. Container trades commonly suffer a slack period until May, when cargo volumes pick up in preparation for pre-Christmas shipments, but that seasonal upturn has failed to materialise this year, confirming for many that the recession in consumer markets will take a heavy toll on container shipping rates. Maersk Line's Group Senior Vice President Robert Steen-Kleedel said the Asia-Europe market was characterised by unsustainable rate levels. All of its Asia-Europe loops have now acquired an extra vessel to reduce vessel speed in order to cut fuel consumption. Details have emerged of individual claims lodged against collapsed dry bulk and tanker operator Industrial Carriers, with ship owners seeking as much as $400 million in compensation for failed charters. The highest individual claim to emerge so far is from B&H Ocean Carriers, which has filed for $24 million against charters it alleges were defaulted on by ICI. A legal source close to the case says that while ICI had settled with a significant number of owners, mostly by assigning charter hire from its own vessels, about 40 claimants remain. The unwillingness of banks to provide letters of credit have hit trade in the dry bulk market and pushed rates down further. On Thursday, the Baltic Dry Index was down 289 points on the week, down at 1,149. The last time indices were so low was over 7 years ago in July 2001. Shipbrokers say that rate improvements depend on banks easing trade credit restrictions. Navios Maritime Partners Angeliki Frangu has warned investors that this may not happen for at least 6 to 8 weeks. Since Lehman Brothers filed for bankruptcy on September 15th, access to trade credit has become a major issue, reducing the number of cargoes available for shipment. As a result, rates for Panamaxes have fallen an unprecedented 80%, while rates for larger Cape-size ships have dropped 87%. The trade credit problems have coincided with falling Chinese demand for iron ore from Brazil and Australia, the mainstay of business for larger bulk carriers. On Thursday, the average time charter rate for a Cape-size closed at around $8,600 per day, and the Panamax equivalent fell to around $7,700. It's now estimated that 30 to 40 Cape-size vessels from the global fleet of 800 ships are being laid up and withdrawn from trading, as tumbling spot rates push daily earnings below break-even costs. Owners of larger bulk carriers are either unwilling to accept business at such low rates, or they are unable to find cargoes. Underscoring the scale of the problems, US investment bank Cantor Fitzgerald has slashed its forecasts for dry bulk freight rates and earnings for the rest of this year and 2009. Forecast rates for Capesizes and Panamaxes have been chopped by 39% to $60,000 a day and $30,500 a day, respectively. In the dirty tanker market, owners are still waiting for refiners to charter vessels to cover their November cargoes. Output cuts from the OPEC oil cartel are also expected to affect crude and oil product exports in the fourth quarter. The result has been drifting rates for very large crude carriers. On the key Middle East Gulf to Japan route, VLCCs were fixing at 84 world-scale points on Thursday, or around $50,000 per day. That's down 9.4 points since last Friday. Rates in the Suezmax market have fared a little better, but are still lingering around last week's levels. The main route taking oil from West Africa to the US Gulf saw Suezmax rates slightly up at world-scale 147, or a daily rate of $55,000 a day. There is better news for shipping in the Gulf of Aden, as NATO announced plans to concentrate significant naval resources on tackling the piracy epidemic off the coast of Somalia. The move will form part of a wider push by the military alliance to re-establish maritime security as one of its core functions. It is introducing an intelligence network alongside a flotilla of NATO frigates, due to arrive in the region this weekend. NATO has received a direct approach for help from a coalition of 4 major energy companies requesting protection for their tankers passing through the Gulf of Aden. Earlier this week, private security contractor Blackwater said it would send its own vessels to the region after calls from shipping companies for improved security. Indonesian owner MISC has given its masters discretion to reroute vessels around the Cape of Good Hope. industry officials confirmed that owners were increasingly prepared to incur additional operating costs rather than risk further hijacks off Somalia. For more information on these stories and many more, plus information on our continuing piracy campaign and reports on how the global financial crisis is affecting shipping, please visit lloydslist.com for breaking news and to view our online e-paper. Thanks for watching On the Radar.